The year was 2012 and a company called Facebook was going public. You're probably wondering, what the f does going public even mean? That's exactly what we're going to cover today. And so in the next 2 minutes, you're going to know more about initial public offerings or IPOs than 99% of other people. Let's go. An initial public offering, or IPO for short, is kind of like a company's big debut on the stock market. It's when a company decides to sell its very first shares to the general public. It's a bit like inviting everyone to become a part owner of the company by buying a piece of it. The most interesting thing about IPOs is that it allows everyday people to become investors in companies that they care about. So you can buy stock in Apple, in Amazon, in Spotify, in Facebook, so on and so forth. Companies that you use day to day and that you believe in, you have access to purchase their shares because they are publicly traded. And so it enables you to be an investor or an owner of them. As the companies grow over time, your shares tend to increase in value, and then you can sell them for a higher price than you paid for them and make a profit. Or you can hold on to them and get paid dividends, but that is a video for next time. In 2014, the massive Chinese e-commerce giant Alibaba, kind of a bit like eBay and Amazon, had a massive IPO. And then 4 years later in 2018, Spotify, the popular music streaming service, went public. This gave music lovers a chance to invest in a company that had changed the way people consumed music. Companies use IPOs to raise money for various reasons. So when they offer their shares, people buy it, they get that money. That money could be used to hire more employees, grow teams, develop new products, pay off debt, so on and so forth. Although IPOs can be quite exciting, they do come with risks. So not always does an IPO happen and the share price of the stock goes up. Sometimes it might actually tank and go down, in which case a lot of early investors will lose a lot of money. Regulation. So IPOs are regulated by governments in order to protect investors. Before a company can go public, it needs to provide tons of information to the government about its plans and its financials and all of these kind of things in order to make sure it's legit and everything is in check. IPOs tend to create a lot of buzz, so a lot of people tend to watch them to see how companies perform on their first day, second day after the IPO, and they create a lot of hype in the media and in the press. It's kind of good marketing for these companies. And then time horizon. So some people buy IPOs or shares in an IPO with a long-term view. They're going to hold on to the stocks for 5, 10, 15, 20 years. Other people buy them with the short-term perspective of selling them in a few days or a few weeks. There's no right or wrong, but different people have different mindsets when it comes to IPO investing. IPOs can be a way for companies to grow and for everyday people to be a part of their success. If you're considering investing in an IPO, it's important that you know the risks and you do your research before investing any of your money into an IPO. With that, make sure you tune in next time to learn another financial term, concept, or idea explained in basic English. Peace.